Welcome, everyone. Today, we are exploring the core foundation of international accounting, the IFRS Conceptual Framework for Financial Reporting. Think of this document as the architectural blueprint for global financial reporting. While it is not a standard itself, it provides the underlying concepts, logic, and definitions that the International Accounting Standards Board, IASB, uses to develop and revise IFRS standards. Let's walk through the core chapters that dictate how global financial information is structured and communicated. The first chapter answers the most fundamental question: why do we report? The primary objective of general-purpose financial reporting is to provide information that is useful to existing and potential investors, lenders, and creditors. These primary users rely on financial reports to make critical decisions about allocating capital. To do this, they need to assess two things: the entity's ability to generate future net cash inflows, and how transparently and effectively management has stewarded the economic resources entrusted to them. What makes financial data actually useful? The framework identifies two fundamental qualitative characteristics. First, the information must be relevant, meaning it can actively influence decision-making, which ties directly into the concept of materiality. Second, it must be a faithful representation of the economic substance of a transaction, meaning it is complete, neutral, and free from error. To elevate this data further, we look to four enhancing characteristics: comparability across time and entities, verifiability by independent observers, timeliness for decision-makers, and understandability. However, all of this is balanced by a practical constraint: the cost of providing the information must be justified by the benefits it delivers to users. Moving to Chapter 3, we define the reporting entity. Interestingly, a reporting entity is not strictly confined to a single legal entity. It can be a portion of an entity or comprise two or more entities. The boundary is determined by what provides the most useful, relevant information to the users. This chapter also draws a clear distinction between consolidated financial statements, which provide a holistic view of a parent and its subsidiaries as a single economic unit, and unconsolidated statements. Chapter 4 outlines the building blocks of accounting, the elements of financial statements. It modernizes the definitions, clarifying that an asset is not just a physical item, but a present economic right with the potential to produce economic benefits, controlled by the entity due to a past event. A liability is a present obligation to transfer an economic resource that the entity has no practical ability to avoid. Equity is simply the residual. Furthermore, income and expenses are defined dynamically by changes in the balance sheet, specifically, enhancements or depletions of assets and liabilities that affect equity, excluding transactions with owners. Once we identify the elements, when do they make it onto the balance sheet or income statement? This is recognition. An entity recognizes elements only when doing so provides both relevant information and a faithful representation of the item. Conversely, derecognition occurs when an entity loses control of an asset or settles a liability. The main objective during derecognition is to faithfully represent both the assets or liabilities retained and the changes resulting from the transaction. How do we assign a monetary figure to these elements? Chapter 6 explores measurement. The framework outlines two primary measurement bases: historical cost and current value. Historical cost relies on the original transaction price. Current value updates the measure to reflect conditions at the measurement date, including fair value, value in use, and current cost. Selecting the right measurement basis isn't a rigid rule. It depends entirely on what provides the most relevant and faithful information about how that specific asset or liability will contribute to future cash flows. Having accurate numbers is only half the battle; they must be communicated effectively. Chapter 7 emphasizes that presentation and disclosure should prioritize clear communication over checklist compliance. This requires logical classification, grouping items with similar characteristics, and proper aggregation so that vital details aren't lost in a sea of immaterial data. The framework firmly establishes the statement of profit or loss as the primary source of information about financial performance, providing strict conceptual boundaries to standard setters regarding what items belong in other comprehensive income. To conclude, the conceptual framework is far more than academic theory. For the standard setters, it ensures that all future regulations are internally consistent and philosophically aligned. For business preparers, it serves as a critical safety net, providing a logical framework to develop accounting policies when dealing with novel transactions where no specific IFRS standard applies. Ultimately, a strong conceptual framework fosters global comparability, builds trust among international investors, and drives down the global cost of capital. Thank you for your time.